All right. Well, good morning, everyone. Thank you for joining us. We are talking about the one big beautiful bill and its tax implications for M&A transactions. We're very happy that you all have joined us this morning. Um, Before we get into the content here, I just want to cover a couple quick housekeeping items. Um, we will be launching poll questions throughout the webinar for CPE credit. To receive credit, you must participate in all three polling questions that you see on your screen during the webinar. If you have any questions during the material or the topics that we're covering, please submit them via the questions feature in your webinar control panel. We will do our best to answer questions live. However, if we cannot answer a question or run out of time, we will certainly follow up after the presentation to get your questions answered. Presentation slides should be available for download from the handout section in the control panel. And the webinar will be recorded and sent out for on-demand access after the session. Finally, at the end of the webinar, there will be a short survey that launches, which will need to be completed to obtain CPE credit. CPE certificates will be sent via email within 5 to 10 business days. All right. Quick introduction. I'm Greg Lohmeyer, a tax director in Sikich's transaction advisory services practice, where I lead our M&A tax vertical, focusing on tax due diligence, deal structuring, and post-merger integration considerations. With me today is my colleague Sharif Ford. Sharif, would you like to introduce yourself?
Sure, thanks. Similar to Greg, however, I'm a tax manager in the Sikich transaction advisory practice, and I also focus on due diligence, structuring, and post-merger integration. It's hard to imagine. I've been in tax over 20 years and have seen a lot of the various changes in tax laws and provisions firsthand. I even was in DC for the Tax Cuts and Jobs Act and was in the room for most of the discussions or arguments, depending on which room you sat in. I've been lucky to spend my career doing what I love and focusing on M&A and clients that help clients navigate different changes in these waters.
Thanks, Sharif. All right, so here's our rough schedule of events here. We are going to discuss a select set of tax provisions from the OBBBA. The OBBBA obviously had many tax provisions. We've chosen the ones that to us were the most material and most meaningful for deal participants. So buyers and sellers of businesses, investors, private equity funds, and other people that participate in transactions and M&A deals in the marketplace. This is not to say this is the exclusive list of tax provisions that could impact M&A, but as I mentioned, to us, these were the most material. So let's get moving and kick us off with the first polling question here.
Which OBBBA tax provision are you most interested in learning about? Increase in SALT deduction, increase in ability to deduct interest expense, return of 100% bonus depreciation, enhancement of Section 1202 benefits, ability to deduct R&E expenses. Looks like the answers are coming in fast and furious.
Here we go.
There's some excitement here.
All
It's like a
right.
little race.
Yes, it's like a race between bonus and the salt cap, it looks like.
I'm surprised. I'm surprised.
Interesting. All right. Okay, a few more responses rolling in. All right, looks like a pretty even split between the return of bonus and the increase in the SALT deduction cap.
Wow,
Interesting. Okay.
very interesting.
Well, obviously, we will be discussing both of those topics in detail here. Before we get into it, let's just do a quick summary of where we were prior to the big, beautiful bill. So I think most of us on the line, experienced the Tax Cuts and Jobs Act, or TCJA, which was one of the most comprehensive pieces of tax legislation, certainly in my career, and probably the same for many others. It provided very, sweeping and expansive changes to the tax code that impacted individuals and businesses, both domestic and international, in a way that was not seen in many, many years. I think, as most people know, many of the TCJA provisions were not permanent and were either intentionally set to phase out, or were even set to expire at the end of 2025. Extending some of the key TCJA provisions has been a top priority for lawmakers and for President Trump, who began promising as much on the campaign trail leading up to the 24 election. Um, Not without its challenges. The OBBBA passed through Congress on July 3rd and was signed into law by President Trump on July 4th. As we mentioned, we'll cover some of the key changes that impact businesses, business owners, and investors with an eye towards M&A. Okay, so obviously we're talking about a lot of provisions that have changed. Before we get into that, I think it's important to note what hasn't changed. As you'll recall, there were many proposals swirling around prior to the enactment of the OBBBA, not all of which made it into the final bill. First, the long-term capital gains rate has stayed the same. The top rate remains at 20%, which generally means that long-term capital gains and qualified dividends will be taxed at this preferential rate, plus the net investment income tax as relevant. This is, of course, welcome news for business owners and investors who are anticipating an exit transaction in the near term and who have come to rely on this favorable and beneficial rate. Secondly, despite gaining some traction with President Trump, there's been no change to the tax treatment of carried interests. Carried interests, generally speaking, are afforded capital gains treatment rather than ordinary income treatment subject to employment taxes. Interestingly, the TCJA signed into law by President Trump during his first term contained new section 1061, which increased the holding period required for long-term capital gains treatment from 1 year to 3 years for certain partnership interests. Generally speaking, investment fund professionals who received carried interest um, uh, are subject to this rule and to these regulations. The OBBBA has not changed the tax treatment of carried interests, and so the rules enacted under the TCJA continue to apply. Obviously, welcome news for U.S. funds and their management, um, who derive a significant amount of their compensation through these carried interest arrangements. So positive change that there wasn't a change, I guess, is the point to make. Okay, no millionaires tax. This was another thing that was given some consideration in the run-up to the act. Many lawmakers were considering the implementation of a millionaires tax, essentially an increase on certain um, individual taxpayers with incomes over $1 million. Fortunately, this change was never enacted. Again, should be beneficial for business owners, investment fund professionals, etc. Similarly, there were some discussions around the corporate tax rate, but ultimately that rate remains at 21%. As many will remember, coming out of the TCJA, um, many businesses considered restructuring their operations from flow-through structures to corporate structures, given this low rate and the ability to manage taxable income. Um, Nothing has changed in this regard. These corporate structures still remain attractive given the permanency of this low rate. Um, as we'll discuss later in the presentation, the benefit of a low corporate tax rate plus the enhanced opportunities under Section 1202 may make these C Corp structures attractive to business owners and certain private equity fund investors alike. Finally, no retaliatory tax on certain foreign investors. This was something that was broadly intended to counteract provisions that were part of the OECD Pillar 2 initiative. Think digital services taxes, undertaxed profits rules. Um, ultimately, this proposal was not passed either, which is a positive development for multinational groups and funds with foreign investors.
Yeah, the title alone was scary. Retaliatory tax.
Yeah, I think it was even called the revenge tax, at least by some. So anyway, positive news there that that was not ultimately enacted. All right, well, let's get into the meat of the uh, presentation here. Sharif, would you like to kick us off with the bonus depreciation topic?
Yeah, sure. Bonus depreciation has been an exciting area thanks to the TCJA. However, as most of you are aware, these provisions included a phase out beginning in 2023. This phase out essentially lowered the bonus amount by 20% each year. Thus, property placed in service in 2025 would have been allowed only 40% bonus depreciation. When TCJ came out, that 100% limit severely got limited by these phase out rules. That was before the OBBBA. With the implementation of the OBBBA, 100% bonus depreciation has been made permanent for certain property acquired after January 19th. This is important because not only makes bonus depreciation applicable for new property acquired, it allows a retroactive treatment for items you may have purchased while these conversations were going on. Essentially, you don't miss out on this benefit just because of timing. This retroactive treatment is a nice addition for clients. Section 179 allows for immediate expensing of certain items and in the past was used to offset some of the bonus depreciation limits. These rules have been adjusted under OBBBA to allow for a much higher expensing limit under Section 179. The Section 179 expensing cap has now doubled from 1.25 million to 2.5 million, but includes a phase out starting at 400 million. Please note, bonus depreciation does not have this cap limit of 2.5 million and does not include a phase out provision. Greg, how do you see these impacting the M&A world?
Yeah, thanks, Sharif. I think, as we saw in the first polling question, that this is certainly one of the most welcome provisions in the OBBBA. Um, I think, most people are familiar with the concept. Essentially, bonus depreciation allows taxpayers to immediately deduct 100% of the cost of qualifying property. Fortunately, the OBBBA does not make any changes to the types of property that are eligible, nor does it impose additional reporting obligations. As such, the OBBBA preserves kind of the broad scope of the TCJA rules. Um, bonus depreciation, again, I think a lot of people are familiar with the concept, but generally it applies to most tangible property with a recovery period of 20 years or less, as long as it meets the acquisition and use requirements in Section 168K. So I think, as some may remember, bonus depreciation does not only apply to brand new property, but also applies to used property, which means property whose original use did not begin with the taxpayer, provided it meets certain acquisition requirements. These used property requirements broadly allow for bonus as long as there was no prior use of the property by the taxpayer or a predecessor at any time prior to acquisition. These rules can be a little bit nuanced, determining, who is a related party, is factual intent is fact intensive. and nuanced. But generally, what that means for M&A transactions is that eligible assets acquired in an asset or deemed asset transaction, so think of a 338H10 or an FREORG transaction, are generally eligible for bonus depreciation. So buyers of asset-heavy businesses are once again able to take upfront tax deductions for eligible property acquired from unrelated sellers. This
That's important. The
is
step-up rules, right?
exactly. This is a huge win, for purchasers in the M&A space as it provides an upfront deduction and significant year one savings. Um, that's not without some challenges in the sense of negotiations. Buyers obviously generally prefer asset or deemed asset deals, not only for tax reasons but also for non-tax reasons. And this is certainly the case now with the return of bonus depreciation. So well-advised buyers, will look to assign a higher value to property that qualifies for bonus in order to maximize that year one deduction. Now, buyers obviously are only, one side of the card here. Sellers in the M&A market, primarily those that operate through pass-through entities, should be cognizant that an asset deal with a heavy allocation to fixed assets may be more costly to them on account of the recapture rules that can recharacterize capital gains as ordinary. So sellers should be upfront with potential bidders regarding their purchase price allocation expectations, and where feasible should look for protection from any incremental tax costs. So think about negotiating for a gross up provision, for example. Um, Sharif, I think we have a new development as it relates to upfront expensing.
Yeah, well, it's pretty funny that, a lot of these rules aren't new, but one of the things that is new is that the OBBA is now has a new provision under qualified production property. Previously, manufacturers of production facilities had to depreciate the cost of that facility over 39 years. Note, some or part of that facility might be treated as property eligible for bonus depreciation or a shorter depreciation period compared to the 39 years, but the bulk of the cost was treated as real property with a 39-year life. Enter the OBBBA, which now allows similar treatment as bonus depreciation with 100% deduction of the cost of certain new manufacturing facilities. It's important to note what is deemed qualified production property, and the requirements are as follows. Even though this is a great provision, we still got to look at the rules. And so one of the things that we do have to note is these requirements. One, it must be used by the taxpayer as an integral part of the qualifying activity. This can't be an ancillary facility. Property must be placed in service in the U.S. The original use of the production property must begin with the taxpayer. Construction of the property must have begun after January 19th. Property must be placed in service before January 1st, 2031. And finally, taxpayer must elect to claim immediate deduction, which is no surprise as the IRS is not going to just give you this benefit. Hopefully, some of additional guidance will come out in regards to what qualified production property entails and its timing for placed in service. But in the meantime, let's try to stick to these dates, but be wary possible depreciation recapture if the facility is no longer deemed to be a qualified production property. So you essentially could be subject to recapture if down the road your qualifying production property is deemed to no longer be qualified. Greg, what is the possible M&A impacts of this benefit?
Yeah, thanks, Sharif. And just before I get there, I do see a question here. Can you provide details on what property qualifies as qualified production property? This is a great question. Obviously, this is a new um, provision, and we'll be looking for guidance from Treasury and the IRS on these matters. But generally, what we know is that a qualified production activity includes the manufacturing, production, or refining of tangible personal property. This includes facilities directly involved in the creation, assembly, or processing of physical goods, emphasizing a substantial transformation of the product. The part of any such non-residential real property that is used for offices, admin services, lodging, parking, sales activities, research activities, software development or engineering, or other functions unrelated to the manufacturing, production, or refining activities that I mentioned above are not eligible for this favorable deduction regime. Additionally, for leased property, the lessee's use does not count towards satisfying the requirement that the taxpayer is engaged in a qualified production activity. The taxpayer itself must carry out the qualifying activity.
Yeah, so I
Um,
can't lease out a building for new widgets and then think I'm going to get that bonus depreciation treatment.
yeah, exactly. You know, we'll be looking for additional rules and guidance here in the coming weeks and months. Um, and hopefully we see some news on that relatively soon. Um, so just kind of circling back here with some commentary, you know, one of the provisions that was discussed during the evolution of the OBBBA was whether to reduce the tax rate for certain domestic manufacturers. So I think President Trump had thrown around, you know, a special 15% tax rate for domestic companies engaged in manufacturing. That concept ultimately was not included in the final bill, at least not as a rate reduction. What we got was this QPP, you know, regime instead. You know, as Sharif was mentioning, this allows for taxpayers to deduct 100% of the cost of qualifying manufacturing facilities. I want to highlight a couple key distinctions from the bonus rules. You know, while the ability to deduct 100% of the cost in the year that the property was acquired, you know, is similar to how bonus works, but there are some key differences. The first is that the original use requirement appears to be more stringent than the bonus rules. So if you recall in the previous slide, I mentioned that acquiring qualifying property that has already been used by another taxpayer is still eligible for bonus depreciation. Here, that appears to not be the case. The original use has to begin with the taxpayer that's claiming the deduction. Um, but there are some limited exceptions here, right? For previously owned property to qualify, it must not have been used in a qualifying production activity by any person between January 1, 2021 and May 12, 2025, and must never have been used by the acquiring taxpayer. Essentially, what this means is that underutilized or vacant properties potentially can be repositioned for a qualified production use and eligible for this deduction. So what does this mean for M&A transactions? So unlike the normal bonus depreciation rules, you know, a buyer appears to be unlikely to get an immediate deduction for manufacturing facilities acquired in an asset deal, even if the seller is an unrelated party. However, that doesn't mean there aren't benefits, you know, for buyers and manufacturing operations who are planning to make significant investments in new facilities. The ability to immediately deduct the cost of those facilities will be a huge benefit to cash flows and to valuations, particularly for targets who are engaged in the manufacturing and production sectors. All right, so Sharif, let's move on to 163J.
Yeah, it's funny because interest expense limitations for businesses is not a new concept, and much of Section 163J has come under scrutiny over the years. However, the TCJA tried to clarify some of these calculations and set the expense in deduction at 30% of EBITDA. But like much of the phase out items for TCJA in 2023, the calculation for interest expense was changed to be based on EBIT. This concept only allowed you to add back interest and taxes when calculating your deduction. The OBBBA, it restores the base of this calculation to include depreciation and amortization. This essentially returns us to the more generous deduction limit, as we can now calculate the limit based on the usual much higher EBITDA basis. We'll walk through an example of this change, but Greg, how do you see this affecting the M&A market?
Yeah, exactly. This is a huge uh, and welcomed change for the M&A sector, in particular for private equity funds or other acquirers who rely heavily on leveraged transactions. Debt pushdowns are a key component of PE funds' acquisition structures, and the limitation based on EBIT coupled with a high interest rate environment, has been particularly painful for funds and their portfolio companies. Um, so, these private investment funds, their portfolio companies, especially those portfolio companies that have significant depreciable assets and amortizable intangibles, are going to benefit hugely from this return to an EBITDA-based limitation threshold. So positive news all around. Let's just walk through a very quick and simple example to demonstrate the impact here. So assume AlphaCo has in 2024 and 2025 a constant EBITDA of $1 million, EBIT of $600,000, and interest expense of $250,000. What is the interest expense deduction limitation in each year under the pre and post OBBBA regimes? Um, so as we see here, in 2024, we had an EBIT threshold, and so the deductibility threshold for interest expense based on these facts was $180,000, which means there was disallowed interest expense of $70,000. Contrast that to the post OBBBA regime, where we're back in an EBITDA world. Here, the deductibility threshold is $300,000, meaning AlphaCo can deduct the entirety of its $250,000 interest expense for the year. As you'll see kind of in the bottom rows here, what that means is in 2024, there would have been an increase in taxable income of $70,000 attributable to that disallowed interest expense, resulting in an increased federal tax liability of $14,700. Again, a simplistic example here, but multiply these numbers, by a significant multiplier, and there's a real, tax impact, to borrowing and to interest expense deductions. So again, positive news, especially for those, PE funds and other companies that rely heavily on leverage transactions. Okay. So, returning to the first polling question, I think that the second most uh, interesting topic or topic of interest was the state and local tax cap. Sharif, you want to walk us through where we were and what's changed?
Yeah, it's while we won't get deep in the woods on state and local tax, it is important to mention that TCJA limited SALT deductions to 10,000 for individuals. If you were in a high tax state, let's say New York or California, you would not be allowed to deduct the full amount of the state taxes you likely paid. The impact was immediately felt by several individuals. The OBBBA has raised the SALT deduction to 40,000, which now allows for a much higher SALT deduction for individuals. This 40,000 limitation will increase 1% per year until 2030, but then the limitation will revert back to $10,000. Unlike several other provisions, these SALT deductions are not permanent and include a phase out for taxpayers which with income above 500,000 and are fully phased out at 600,000. Even though these SALT deductions are at the individual level, it is important to note that note this here because these limitations force states to begin looking at ways to work around these limits. Enter the pass-through entity tax. This allowed companies to pay their required taxes at the entity level. The key item I would like to point out here is that the OBBBA did not limit or change the pass-through entity tax. There was a huge discussion around this as people feared there would be a limit in place and pass-through entities' ability to pay these taxes, but the OBBA did not touch it. Greg, how do you think this provision will impact deals going forward?
Yeah, thanks, Sharif. I think, increasing the salt cap, has been a priority for lawmakers on both sides of the aisle, basically since it was enacted under the TCJA.
Mhm.
So I think a positive development here to see the cap raised from $10,000 to $40,000. Um, yeah, as Sharif was alluding to, in response to the salt cap, many states enacted pass-through entity tax regimes as a response. Um, and essentially, what this does, as Sharif was mentioning, is it permits pass-through entities to file an entity level tax return, which means that they could fully benefit state income taxes against their federal income tax liability. Um, this clearly is a workaround to the salt cap, and as Sharif was mentioning, a lot of commentators and practitioners were concerned that there might be a limitation on the ability of taxpayers to use that workaround. Um, so, what does that mean for M&A transactions? Ultimately, a higher cap is good. Obviously, there's no limitation on the ability to use the PTET workaround, which is great. So what does that mean? For sellers of pass-through businesses, in asset or deemed asset sale transactions, the ability to file a PTET return in the year of the sale allows the individual owners to fully benefit those state taxes against federal taxable income when they might otherwise be limited by the SALT cap. Um, think of an S corp, example for a second. Sellers of S corps often ask for tax gross ups to mitigate the incremental tax cost of selling assets versus selling stock. The availability of a PTET filing may mean that sellers are in the same or sometimes even better position by selling assets versus selling stock. So this PTET regime, oddly, has greatly eased and probably will continue to ease the calculations and negotiations around these tax gross up provisions, in particular in the S corp context. Ultimately, the PTET workaround has aligned buyer and seller interests, which is a welcome result, for those of us in the M&A and deal space. All right, R&E, another hot topic.
Hot to say the least. Research expensing has changed over the years and is always up for debate. The TCJ allowed for deducting these items through 2021. However, starting in 2022, some of these items had to be capitalized and amortized over several years. While you did not lose the deduction, you had to spread it out over time. The OBBBA has now removed some of the ambiguity around the future ability to deduct these research expenses by making it a permanent deduction for domestic research and experimental costs. Companies can now invest more in research without worrying about possible limitations imposed in the future. In addition, the OBBBA allows for entities who are currently amortizing their expenses to deduct them either fully in 2025 or spread these deductions out between 2025 and 2026. This is a great planning opportunity for companies to take a look at their research expenses and future of the company. The OBBBA also added in a nice ability for small businesses with 31 million or less in average annual gross receipts to elect to carry back these expenses. These are new benefits made available from the OBBBA. Greg, how do you see this impacting the market?
Yeah, thanks, Sharif. So this is obviously a welcome change, for R&D heavy businesses. Not only, those businesses that are anticipating a transaction, but, those that invest in R&D in their, normal operations.
Mhm.
The immediate deduction of these R&E costs is going to have a significant impact in the sense that it will reduce taxable income on an annual basis, providing for additional free cash flows. Um, this could make target companies, for example, in the life sciences, tech, biotech, other R&E heavy industries more attractive to buyers who may have been reluctant to wade into the negotiation waters given kind of the misalignment of R&E investment and the ability to deduct those expenses for tax purposes. So something I think like all of the topics, honestly, that we've discussed today, this was a huge thorn in the side of taxpayers and tax practitioners. So to see this kind of return to the early TCJA rules, is a welcome development, across industries and across sectors. All right, let's do another polling question here.
Which OBBBA tax provision will be most beneficial to you in your transaction? Bonus depreciation and media expensing, increase in interest expense deduction limitation, enhanced Section 1202 benefits, or all of the above? Not as much as a split here. Well, a little bit. Answers are rolling in. This stuff is so beautiful, it's got me tearing up. Love tax. Oh, bonus
All right,
depreciation looks
yeah,
like it's taking the
wow.
lead.
Bonus depreciation, a clear winner here. I think, Sharif, let me know if you think differently, but I think for our kind of sector of the market, which is to say middle market, lower middle market, we see a lot of asset or deemed asset transactions, um, and, and the ability to take bonus depreciation on assets that were acquired as part of an M&A transaction is hugely beneficial because it's an immediate um, upfront deduction, year one tax savings, and also for buyers, in particular private equity funds, who look at tax benefits on a present value basis as part of their overall deal model. Um, the ability to take a very large or significant deduction in the first year following acquisition, is such a huge benefit.
Oh yeah, I definitely think the
Um,
market was hungry for that, and it'll be interesting to see how this QPP rules also help add to that.
Absolutely, absolutely. One question that I saw here in the chat: do buyers and sellers have to agree to how property is allocated? Can't they do what is more beneficial for each? In short, the answer is no. They can't do what is most beneficial for each party. Um, the rules under Section 1060 require buyers and sellers to agree to an allocation um, for tax purposes, and oftentimes, if not all of the time, purchase agreements will specifically require the parties to collaborate and reach a conclusion on purchase price allocations. Um, Oftentimes for smaller deals or lower middle market deals, the parties, will agree amongst themselves. Um, Certain other, transactions may introduce, the a third party valuation firm to do the allocation and the fair market value assessment. Um, that third party valuation is not necessarily required, but what is required is that the two parties agree to how the purchase price is allocated.
And that's usually a huge part of
Obviously,
the negotiation.
yeah, exactly, and especially now, right? As we were discussing a little bit earlier, there is this kind of natural tension between buyers and sellers as to how they allocate the purchase price, especially to fixed assets, because for buyers, the ability to immediately deduct those costs is a huge benefit. But for sellers, any increase in the value allocated to fixed assets may come with a cost in the form of depreciation recapture. So it would be nice if both parties could choose the option that is best for them, but unfortunately, the IRS doesn't feel the same way. Okay. All right. So we wanted to kind of reserve, a big piece of the time here to discuss the enhancement of Section 1202, which relates to qualified small business stock. I think for us, just as a little preview comment, this is a very exciting area under the OBBBA. I think this is going to lead to a lot of hard decisions about how companies organize their tax structures, and this maybe puts a bit of a thumb on the scale towards operating through a C corp structure.
Mhm.
But Sharif, I'll let you go through kind of the prior law and what's changed under the big beautiful bill.
This is an extremely favorable provision, and while Section 1202 is not a new concept, it's popped up time and time again. My first presentation on this was at the Harvard Club way back in 2014. However, the ability to utilize the provision has been difficult to navigate. For those who are not aware, Section 1202 allows a company to be structured in a way that allows for its qualified small business stock held for 5 years to exclude 100% of its capital gains upon sale. If Greg and I start a business, we could structure it so that we receive original issued small business stock, and then when we sell it in the future, say for $10 million, dollars, that amount, $10 million dollars of gain, would be excludable from income. This was an amazing concept. However, remember, you had to hold this for 5 years. And we won't mention the potential double taxation if Greg and I tried to pull money out of the company. The OBBBA has updated this provision to allow a partial deduction before the 5 year holding period, or rather exclusion. Previously, Greg and I would have had to hold our company for 5 years. Now, the OBBBA allows you a partial exclusion. If you sell after 3 years, you get 50%, and after 4 years, you get 75%. This is a major change, as when planning into a structure, you don't have to think, well, we can't do anything for 5 years. In addition, for added incentive, the OBBBA increased the maximum gain exclusion to 15 million or 10 times basis. So instead of 10 million, if Greg and I sold for 15 million, we'd be able to exclude all of those gains from our income. If this was not enticing enough, the OBBBA increased the gross assets threshold from 50 million to 75 million. Thus, you could consider larger entities for these provisions. I know that may seem like a lot to run through, but we will walk through an example of these changes. Greg, what benefit do you see these changes having in the M&A landscape?
Yeah, thanks, Sharif. You know, I think in short, the benefit here is huge. Um, so Section 1202, it's been around for a long time, since 1993. However, it wasn't until the TCJA, when there was a 100% exclusion coupled with a low corporate tax rate, that we saw serious widespread interest in Section 1202. The changes and enhancement to Section 1202 under the OBBBA, should only increase the popularity of this section and this planning. Um, with a shorter holding period requirement, more PE funds may choose to structure investments to take advantage of Section 1202, given the ability to structure into an exit after 3 or 4 years and still receive some benefit. Additionally, the increased asset threshold means that larger startups or growth stage companies remain QSBS eligible.
Hmm.
There should be, as a result, an expanded pool of eligible targets for funds who are seeking to structure into QSBS eligible holds. The changes that Sharif, summarized at the top here are effectively the only changes to Section 1202, which means that the QSBS eligibility rules remain, determining what type of business is a qualified small business, tracking the substantially all tests, ensuring that the anti-churning rules are not triggered, etc. These rules are factually intensive and can be cumbersome to deal with. So as the benefits of QSBS eligible investments expand and more business owners, funds, investors, try to structure their investments to take advantage, the need to thoroughly diligence QSBS eligibility early on and to track compliance throughout the duration of the hold is absolutely critical. As I mentioned, very positive, not only for sellers of qualified small business stock, but also for funds and other investors to structure their investments to take advantage of this great benefit in the tax code.
Greg, a question just popped up, which I think is kind of important and a little bit of distinguishing. It's only eligible for C corps, or is it S corps allowed?
That's correct. One of the requirements of a qualified small business is that it is a C corporation for tax purposes. As such, S corps, do not qualify kind of under the terms of the law. That's not to say that there aren't restructuring options available. So for businesses who are operating through an S corp structure or through a partnership structure, there can be techniques available to restructure those interests into a C corporation structure and then start the holding period to take advantage down the line.
Mhm.
All right. So um, just a few kind of numbers here for you. So as we mentioned, if you hold the QSBS for at least 5 years, the amount of the exclusion remains 100%. What the OBBBA has changed, however, is that holding periods of at least 3 years but less than 4 will allow taxpayers to exclude 50% of eligible gain. And for taxpayers holding those investments for 4 years but less than 5, that exclusion percentage goes up to 75%. So what does that mean? Essentially, if you exit after 3 years but before 4, you'll pay an effective tax rate of 15.9% on the realized gain. If you sell after 4 years but before 5, that effective tax rate drops even further to 7.95%. So contrast this with, the normal long-term capital gains rate of 20% plus the 3.8% net investment income tax. And you'll see that even after 3 or 4 years, despite not getting 100% of the gain excluded, there is still a very tangible tax benefit to be obtained. All right. So let's walk through kind of a quick example here. Um, so assume an initial cash contribution post OBBBA to a qualifying small business of $500,000. Assume a sales price of $20 million, and therefore we have a gain on exit of $19.5 million. Um, so let's walk through a couple examples here. If the hold period is at least 5 years, the amount available for exclusion is $15 million. So that is the increased exclusion thresholds under the OBBBA. So that first $15 million is excluded and is not subject to tax. What does that mean for the remaining 4.5 million of gain? That remaining $4.5 million is subject to the standard long-term capital gains rate of 20% plus the 3.8% net investment income tax. What about after a 4-year hold, but less than 5? So here, I think it's important to note that the $15 million exclusion amount is applied first, meaning $15 million is the maximum amount that can be excluded. Here we have gain in excess of that $15 million, so we apply the $15 million threshold first, and then we take 75% of that $15 million for an $11.25 million exclusion. The remaining gain will be subject to tax. However, the first $3.75 million of eligible gain is subject to a 28% rate, which is the rate that was applied in the early days of Section 1202, and which is again relevant here. So that first 3.75 million is subject to tax at 28% plus the 3.8% net investment income tax. Thereafter, the remaining gain of $4.5 million, as I mentioned in the 5-year example, would be subject to that 23.8% rate. So if you hold for at least 4 years, but less than 5, you'll have gain on exit of $19.5 million, but with only a total U.S. federal income tax liability of around $2.1 million.
So essentially, you get a
Last,
benefit because you get the exclusion, but you also get a little bit of a penalty because you get that increased rate under Section 1202 for that little portion that's missing, right?
yeah, exactly. So basically, the remaining eligible gain, meaning the remaining gain up to that $15 million cap, is subject to that 28% rate as opposed to the standard long-term capital gains rate of 20%. So the final example, if the hold is at least 3 years but less than 4, again we take that $15 million exclusion threshold, which is applied first, and then 50% of that is $7.5 million. So that's the amount that is excluded under the new 1202, with the remaining $7.5 million of eligible gain subject to that 31.8% rate, and the gain thereafter is subject to the 23.8% rate. So I think that the takeaway here, and as we alluded to on the previous slide, is that there are still benefits to be had even if you don't hold the investment for the full 5 years. Holding it for 3 or 4 years is still more beneficial than the full long-term capital gains rate of 23.8%.
Hmm. Great benefit here.
Yeah, absolutely. Okay, as we are winding down here, we will have our final polling question.
Which element of the revised Section 1202 will be most impactful to you? Ability to obtain benefits with a shorter holding period, higher gain exclusion amount, higher gross asset threshold, or all of the above? It looks like all of the above is running away with this one.
Yeah,
It'll be
I
interesting
think.
to see the impacts of this.
Yeah,
All
I
this
agree.
change
I
is
mean,
very good.
honestly, it's all good news as far as 1202 is concerned. It's only gotten better. Um,
Mhm,
you know, as we mentioned, some of the factual diligence that needs to happen to ensure eligibility, is still a challenging part of the analysis. But the benefits certainly are, much greater than they were under prior law.
mhm.
All right. Okay. So it seems that all of the above is the answer here, and I think we certainly would agree with that. Everything that's changed in 1202 land is a benefit for taxpayers who meet the requirements. And so, yeah, a lot of potential opportunity here. Certainly, Sharif and I can assist with uh, answering your questions on Section 1202, thinking about ways to structure into it. But it's all good news as far as 1202 is considered.
Yeah, and as far as additional items, we provided a little bit more of a robust background, and we have an on-demand webinar that we've done previously that kind of is more all-encompassing, so not just focused on M&A. We also attached an article focused on federal estate and gift tax changes, and we have one for non-for-profits. So even though me and Greg we focused on the M&A world, we do have other resources out there for
Yeah, thank you, Sharif. All right. Well, that was it for our webinar today. Thank you all for joining. Thank you for your thoughtful questions. Questions that we didn't get a chance to answer, we will follow up over the next coming days. Um, if there's anything else that you would like to speak with Sharif or myself about, please feel free to get in touch. We've included our email addresses here. Otherwise, please feel free to contact your existing Sikich tax advisor, and they can certainly help answer questions for you as well. All right. Well, with that, thank you, Sharif, for joining me today, and thanks again to everyone for listening to this great development in the tax code.
you. Have a great one,
Thank you all
everybody.
very much, and have a wonderful Wednesday.